So what are you trying to actually achieve? Because that really explains a lot of things about how you should be investing. What are we trying to achieve? Do we need income? Do we need capital growth? Is this for kids in 5 years' time? Is this for retirement in 20 years' time? The baby boomers are fortunate that they've got something in the order of 3.5 trillion sitting in their superannuation accounts and 3.5 trillion in properties. There's diminishing returns when you're trying to cut expenses. The most exciting way to improve cash flow is earn more money.
Welcome everyone. Paul from Snow Law and Associates. I've got Jay Burke from Burke and Britton Financial Planning with me today, talking about all things financial planning and future investments. How are you, Jay?
Good, thanks. How are you, mate?
Yeah, not doing too bad. Not
good.
enjoying this rainy weather at the moment, but
Yeah.
we've already had our fake spring in Victoria and moving into the hotter weather soon. So
Hope so.
But the market's doing interesting things. Footy season's finished, so normally people go around looking at houses and looking at investments. How are you finding your clients playing with their SMSF portfolios, or are they being creative in any ways? Because there's a lot of disinformation out there, or marketing influencers who are saying get into crypto.
Yeah, okay. Well, there's a bit in that. So markets, SMSFs and crypto. So maybe on the markets just more broadly, I mean, one of the things that we're pretty conscious about is that if clients are getting too excited, if our existing clients are getting too excited about the market movements, then we've probably done something wrong early on in the piece to sort of educate them about what the markets do. So part of our job is to actually give people sort of the education on what market cycles look like, so that they try to be as little emotionally attached to investments as they possibly can be. At the moment, the markets more broadly are at all-time highs. So equity markets are at all-time highs. You look at things like crypto. Every second person is telling you that they've done well out of crypto. The people that haven't done so well probably haven't told you about that. Yeah, and then property prices, if we're talking about self-managed super funds that can sort of accommodate all assets, property prices, again, although they've come back a little bit after some peaks, are still at relative highs. So I did a podcast a couple of months ago about where to deploy your money, because there is this question about what you actually do with your funds if you've got some surplus funds, whether it be in super or outside of super. I think the first port of call for most people is just to understand what the motivation is. What are you trying to actually achieve? Because that really explains a lot of things about how you should be investing and whether or not you should be investing in crypto, direct residential commercial property, or direct shares. What are we trying to achieve? Do we need income? Do we need capital growth? Is this for kids in 5 years' time? Is this for retirement in 20 years' time? So that's my elusive answer, mate, to that question.
Obviously it's context specific when you've got young professional versus, your clients who are coming to the end of retirement.
Yes.
In terms of are you finding a lot of younger professionals coming to see you now thinking about future investments and setting themselves up for retirement, or is it still that later age generation that's coming?
Historically, our industry is kind of baby boomers, because that's where the wealth sits. So the baby boomers are fortunate that they've got something in the order of 3.5 trillion sitting in their superannuation accounts and 3.5 trillion in property. So a lot of the assets Australia-wide sit with the baby boomers. But the next generation, which is me and you, there's the sandwich generation of professionals that are, I think, the ones seeking most advice at the moment. The reason being is because that they're worried about themselves, so they're worried about their business, their tax position, how they invest. But they're also worried upper generation, so they're worried about their parents and aged parents moving into aged care or residential care. And just like we were talking about just before we hit record, our kids, we're worried about our kids, and we're thinking about how our kids are actually going to be able to afford to own a home, and what are they going to do for work? What's technology going to do to the workforce?
Yeah.
So that sort of sandwich generation is, I'd say, probably our largest growing portion of our client base, because there's so many things that they're thinking about and so many areas that we can support them with.
Yeah. That's a good term, actually. We might be able to coin it the Avo Smash generation.
Yeah.
The way that the mass media portrays us. And I think you're right. I think definitely it becomes a legacy thing for our kids, because we were brought up with the the dream brick and mortar home with a white picket fence and having a loving family. I worry about, as we were discussing earlier, what does work mean for this next generation of children?
Well, what does family mean?
Yeah, do they want to own a home?
Do they want to have kids?
Yeah, like there's so many endless possibilities espoused to future generations, and I think that's why it comes home to legacy and planning for that legacy component, because if you don't have a solid foundation for growth, then all the hard work that's been done by that baby generation is just going to go and dissipate and going to get wasted away. And one of the things, I talk about in my profession with testamentary trusts is that wastage element, that kids will get their inheritance at an early age. And, you can set a preservation age, but who knows when anyone's going to grow up and have kids and become mature to have their head set on straight.
Yes.
If you're inheriting $350, $500, $1 million, what are you doing with it? And in terms of, tax minimization or tax strategies which favour you, do you want to get that $1 million straight away, or do you want that to flow through a trust for the next perpetuity period, 79, 80 years odd, for your grandkids? And I think not many people are focusing on that legacy component. Yeah, inherently we're worried about our own selfish needs. But when you're talking about, 100 years down the track, we don't know what the world's going to look like, given that it's changed so much in the last 50. So what sort of strategies do you use to try and get out to that sandwich generation, or to, help them focus on long-term growth? Because everyone wants a quick buck, quick turnaround. They want to make an instant profit, and they want that instant gratification. How do you, emphasize the importance of 10, 20, 30-year plans and how that compounding interest over time works for you?
Yeah. Well, the answer to that's kind of the evolution of the industry. Like I said, the baby boomers, financial planning historically was investment management around superannuation. Australia is very lucky that we have this mandated super guarantee. And the baby boomers have been very fortunate that without doing a lot, they've been able to grow significant wealth with superannuation, and property prices have continued to grow. However, as advice has been required to go down a generation, our challenge is to get them in earlier, is to get people in as early as we possibly can. So for us, I said before that the sandwich generation is looking up, but the baby boomers, we want them to be looking down, and we want them to be looking at their kids and their grandkids, and start that program of sort of installment investing from a very early age. For a lot of us, that can be we encourage all of our clients to think legacy-wise about their kids and their grandkids, even to the extent of setting up investment trusts, investment bonds, family trusts early, so that you can actually grow wealth in the most tax-effective manner. But also, we very much try to avoid that sugar fix of hunting the next big thing. Encourage people to know that it's a long game. No matter what, it's a long game, and the challenge is to have consistency and discipline in cash flow, number one, and then divert that surplus cash flow into something that's going to grow over time. So again, the strategy for us from a business is look after a family group, the family group up, down, sideways, and make sure that every generation is getting education and expertise about what they should be doing, because there is going to be a transfer of wealth from the grandparents to the parents to the grandkids. And like you said, if you don't want your grandkids to be delinquents and destroy the legacy, what can you do to avoid that? Well, you can put in structures in place. You can put some sort of testamentary structures in place. You can try to rule from the grave from some degree, but you can try. But I think the best investment that people can make is educating their kids and their grandkids. And one of the reasons we do things like podcasts and long-form conversation is to let people understand what they should be doing. Let people understand what good cash flow management looks like what good disciplined investing looks like, and get rid of the hype, focus more on the discipline and education of investing.
Yeah, I mean, in my field, in conveyancing and property law, we see a lot of quick turnarounds. Buy an investment property on an SMSF, create a discretionary family trust, go and buy a property, flip it in the next 5 years, make a quick buck, move on to the next job. The problem is you've got so much initial setup costs, stamp duty fees. The the cost of acquisition versus the ROI in the end is minimal. But if you do it well enough over time and you're happy doing all the rigmarole, but speaking to lawyers, brokers, planners, yes, it can work well for you. And that's probably the traditional model. I wanted to dive deep in with you what you mentioned earlier in terms of investment bonds and cash flow models, because not many people know that these investment mechanisms exist. And some of them you're probably a bit scared by it, coming from Hollywood and the mass media in terms of, we saw the recent hype on gold. Gold and silver has always been a solid investment in my books. Crypto, not so much. But,
depends who you're asking, doesn't it, really?
Well, that too, and when I saw the mass media and the hype go up, I said, well, there has to be a crash because people are going to, the people who are hoarding the gold are going to try and divest their initial investment and try and make some money back on what they've chucked into gold. So, but gold and silver will always be a solid investment because that's why US used to back their dollar by the gold standard. How do you find playing with these different investment mechanisms with clients works? Are they attracted by those?
Well, some are. It's an interesting piece of what we do in terms of investment management. So investment management is one piece of the jigsaw puzzle, and every person is very individualistic when it comes to their preferences around investing. What I think I know for sure is that if someone doesn't have the time or the inclination or the education to be playing with the stock market, with meme coins, cryptocurrencies, property, they should outsource some of that expertise to someone that can help them with it. There's people that they're very well versed in that, and they should do it, and they probably don't need financial advisors. That's their hobby, and they're great at it. One of the things that we've found, even as financial advisors, we also have to seek significant external counsel when it comes to investment management. One of the biggest evolutions in investment management for us has been, rather than managing investment portfolios ourselves internally with an investment committee, we actually bring an external research house onto our investment committee to do all of the day-to-day nuts and bolts of deciding whether or not we should be adding more into resources, whether we should have some exposure to precious metals, to technologies, AI, and that has probably this idea of having separately managed accounts it's probably been the biggest evolution in investment management in financial planning of recent time. So a lot of that decision making now, we have great third-party research that will actually tell us, hey, it's time. Like, we have a formal investment committee every 3 months. In March, when Trump brought his tariffs in, Liberation Day, I think it was, we had 3 investment committee meetings in the space of 48 hours, and we were actively making changes to portfolios. If you're trying to do that yourself, or you're trying to do that across multiple clients all at once, it's almost impossible. So the benefit of actually having investment management that allows you to do it at a global level. So when we make a change, that change occurs across all of our client portfolios. And I think that I'm seeing is probably because what you can do with that is you can actually provide people with the research and understanding, but you can also actively make the changes when the market requires it. Rather than, if it's time to, trim some off Commonwealth Bank, but I've got 500 clients that have got Commonwealth Bank holdings, and I've got to go around each of them individually and have them sign their to activate the trade. Sometimes we'll lose that moment. So you need to be able to act very quickly.
It's interesting you say that, because I've looked at the influencer market on stock brokering and crypto, them saying, we'll teach you how to do it. And I've gone in and looked at a few courses myself, and you're really gambling with your money on the. If you do not know what you're doing on the stock market, you're really gambling with that. And like you said, some people are good at it. They can cut the emotion out and get ROI on their initial investment. It's good to hear that you've got a third-party expertise coming in to do the due diligence portion to allow you to make those agile movements and decisions, because you're right. If you don't act sometimes within an hour, you could miss a sale price on a stock or move as required.
100%. Or a sector, like a particular sector is about to fall out of favour. It's important to be able to move quickly. Interesting on the the finfluencers online, and again, I'm probably, arguably now I'm on social media, I could be considered a finfluencer, but I'm a registered financial advisor, a certified financial planner. But a lot of those courses that you see, the only one getting a return on investment are the ones selling the courses.
Yeah.
I mean, the money's in. It's a whole cottage industry in selling courses, and I think it's great. Like, people should educate themselves, and that's awesome. So go and do the course. But if you think that that's going to be the holy grail to you being able to outpace the market, then you're in trouble. Many people have tried before. Many people have failed. That's why sometimes people will revert back to index investing and just go, I'm just going to follow the market. Whatever the market does, I was going to hold a bit of all of the market.
Yeah.
Market will go up, market will go down, and I'll be disciplined to stay in the market. And the old analogy, I reckon I said this on the last time I was in this podcast studio, that it's about spending time in the market more so than trying to time the market. If you're trying to time the market and that's your strategy, you're probably bound to fail more than you will succeed. But if you are disciplined and you spend time actively in the market and spend time actively contributing into the market, history suggests you'll do better.
It's like that saying, when you're betting against the house. I think the only time that worked was the subprime market in America, when they were betting against the house. But you're right. I think Anthony Robbins, in his book on the share market, said if you're out of the investment market for 1 year, you lose maybe 50 to 100 grand over a 20-year period. Obviously, compounding interest works that way. But it's interesting because I don't think a lot of consumers know that level of detail you go to when you're making those investment decisions on their behalf. Because, from a consumer's perspective, I'll analyze my own behavior. I'll log into my Aware Super portal and just, okay, what sort of risk can I do? What sort of choice can I do with my investment strategy online, just with an industry super fund? And that's me as a professional, right? So I feel like there's a lot of young professionals out there that haven't even gone and sought that type of advice to say, hey, what can I actually do when I create my own self-managed super fund to get a return on investment?
Yeah, what's suitable, right? Because the universe of super funds is enormous. Every super fund or every person will have preferences or suitability for particular funds. I mean, the self-managed super fund is the fastest growing area of superannuation in our business. But like you said earlier, you've got to be very cautious about who it's suitable for and make sure you look at the return on investment. I mean, setting up a self-managed super fund is not an inconsequential cost. And a lot of the forecasts that I've seen for property spruikers, just for probably a word of warning for those people out there that are hearing a property being spruiked with the self-managed super fund spruiked at the same time. Generally, what you've got is someone selling property and trying to second the superannuation to fund that property. They're working in cahoots. It's not that it's necessarily illegal or unethical, but you just got to go in with your eyes wide open. Sometimes, like anything, if you've got some sort of advocate in your corner, a solicitor or a financial advisor that can sort of give you some external counsel to say that is a good or a bad thing, that's what I encourage you to do. Make sure that you don't just take as gospel what anyone says, whether it's myself or Paul.
You're right. I'm finding a lot of clients coming to me and saying, what's your actual recommendation to make their decision on their behalf? And sometimes I have to say, well, it depends how risk averse you are, because I'm going to advise you on best and worst case scenario, but I'm going to tell you if it goes bad, then this is the consequences of it. So it's funny because I understand when clients want to lean on you for your expertise to make the decision, and when it's in that context, more than happy to make the determination for them. But sometimes when you've got clients who have several SMSF structures and are educated businessmen, you've got to let them make the decision on their own and just give them the options, because they've been in those scenarios before.
And again, hunting for the purpose too. Like, what are we actually trying to achieve here?
Yeah.
Because just because my next door neighbour's got a self-managed super fund, he told me he bought a property in it, isn't a great reason for you to do it. Like, are you self-employed? You house yourself out of your own commercial premises? That's probably I've had a few clients of recent time with that scenario of they probably don't have as much in super as necessarily. We'd like to see them buy commercial property or have we call a limited recourse borrowing arrangement, but it might make financial and individual sense for them to buy a commercial property that they house themselves out of and rent that property from their super fund. So again, it's horses for courses.
Yeah.
And this is the value of advice. This is the value of actually speaking to people about the pros and cons and working out what it is that is going to be suitable for you.
Yeah, and I think the biggest concerns I hear from clients are, like you said, the cost to set up these structures, and you could easily blow 5 to 10K if you're not talking to the right people or getting overcharged by different professionals. Like you could go to Maddox Lawyers in town and get overcharged triple the price that you could go to a suburban or regional law firm or accountant firm. So yeah, you've got to find the right professional team to support you because it is a long-term journey. I'll talk to clients sometimes about what returns their planners are getting from them. Clients that we are comfortable sharing that type of information, and some of the returns they're getting, I freak out and I say, well, let's have a chat, because if they can do that for their clients, getting 20% returns, we're talking about baby boomer generations who have significant investments, but that sets them up for retirement. Our sandwich generation are now worried about setting ourselves up for retirement and then the future. I see a lot of Instagram posts from people in our professions now, relatively, who are now marketing themselves and giving out this information. And some of the stuff that I get from clients is posts from American type structures, like investing in an insurance fund and letting the compound interest. Now, we do have those mechanisms here, but you need to talk to the right people.
Yep.
Like you said, people won't know about buying a commercial property as the SMSF entity and leasing it to yourself back as a tenant. And people are like, well, how are you supposed to do that? It has to be arm's length. It's like, well, if you're doing a commercial lease on market terms, it's still all arm's length, despite being related as the SMS entity to yourself. You're still doing the right thing as a trustee of the SMS by earning that income back. What the ATO are worried about is essentially you buying an Airbnb in the Gold Coast and renting it back to yourself. Yeah. Right? So
I've had those questions before. Plenty of people say, I want to buy an investment property. I want to buy a holiday home, but I want to use my super for it.
Yeah. You can't.
I've seen people try to do that and they come to us after the fact, and the penalties for that are outrageous. And the penalties for a self-managed super fund being non-compliant are just not worth it.
No.
Talk about eroding your investment return. You definitely need to seek some support. But on the flip side to that, I mean, superannuation is there's an enormous pool of assets there that people now more than ever can have influence over how those funds are invested. Historically, superannuation has been the statement you get, your boss puts some money into and you put it in the bottom drawer, you don't look at it. Now you're actually kind of in control. Like you can now decide everywhere from industry fund, a retail fund, like a wholesale fund where you can pick, shares yourself, or have a separately managed account through to a self-managed super fund, and have multiple family members aggregate assets to go and buy commercial properties, residential properties, as long as they're at arm's length. But yeah, it's just about working out what's actually going to be suitable for you, not just doing it for the sake of it. Having some purpose and understand what your direction is.
Yeah. So in terms of the jigsaw puzzle, what other mechanisms or what other pieces do you see are extremely important in giving the client that holistic picture of financial planning services?
Yeah, I actually have. We actually present a jigsaw puzzle. So the reason I use jigsaw puzzle is on our initial client presentation, we have a jigsaw puzzle which basically shows the interaction between. Most people come to us with one thing in mind. They go, I want to buy a property in super. Right? I go, cool. All right, let's talk about that. When you start to unpack that, what you realize is that it might be a good idea, but we need to think about legacy. So we need to think, have they got estate planning sorted? Have they got wills and powers of attorney? Are their beneficiary nominations on their existing super or their proposed super as they want them to be? They got a chunk of debt because they need to protect their family, like you and I. They've got kids, so insurance comes into the equation. If we're talking insurance and debt, we're talking debt management and investment management just broadly, superannuation, non-super, trust investments. They all form part of it, and probably the most the simplest probably the most boring, but the most important aspect of any sort of financial planning is cash flow management.
Yeah.
Because nothing else matters. Like nothing else matters. If you don't have a handle on what comes in and what goes out, and know whether you're in surplus or deficit. Like people who've heard me on podcasts before get sick of me saying this, but people jump about 3 steps ahead to what they should be doing, buying crypto or setting up a self-managed super fund. Let's wind it back and say, let's talk basically, whether it be individually or as a business, what does your cash flow look like? Because I can give you the best recommendations in the world, but if you can't actually afford them, it's pointless. It's irrelevant. But from a cash flow point of view, there are plenty of things that you actually can do to improve cash flow. You can mitigate tax. So you can take one of those, what most people outside of their mortgage, probably their biggest expense item in their budget, whether it be business or personal, is tax. Most people don't have very many tax strategies in place, both now and maybe long term, to think, how do we actually keep more of that money that's currently going to the tax man? How do we make sure we keep more of that in our net worth? If we keep more of that in our net worth, then it's going to compound somewhere. It's going to compound in our bank or investments, in superannuation. It'll form part of an asset in super. The simplest example, and the taxman's done a pretty good job of squeezing all of the holes down, like what we could do, and I'm sure there's going to be more squeezes to come in the future. But for young professionals, if you talk, I know we sort of talk super, tax. If you're on a good income and maybe you've progressively grown to the point now you're on a pretty good income, top marginal tax rate, like me, maybe in your late 40s, you got a bunch of kids. Super contributions, I know super gets like it feels like a very long-term thing. But when I'm 47, I'm 48 in December. 12 years, I'm 60.
Yeah.
Right? The last 12 years of my life went like that. In 12 years' time, I've got access to a tax-free pool of money in superannuation.
Yeah.
So what's one of the strategies that I can make use of? I can make additional contributions
100%.
to super.
Yeah.
A lot of people don't know that if you haven't historically contributed to your super, maybe because you didn't have the money or cash flow didn't allow you to, you've got what we call unused catch-up contributions. So you can go back to the current year plus the previous 5 years.
They'll probably reduce that to 2.
Probably, but while it's there, again, while it's there, use it. So if you've got, at the moment, it's 30 grand you can put into super. It was progressively a little bit less the previous 5 years. But any unused amount that you've got in previous years, you can use it. You can use it in the current year to claim a tax deduction to help offset income, capital gains. It's an exceptionally good and underutilized strategy. But again, it's very dependent upon cash flow.
Yeah, of course.
Which is why I said
that's a gem, though. Like if you can claim back 150K. What?
Yeah, if you hadn't used it, yeah.
If you can, say for example, because one of my clients' favorite mechanisms in working with their financial planners for retirees is that as soon as they sell their home, they can chuck in 350 grand or whatever.
Contribution.
Yep. That's right. So they essentially can hide whatever profits they can into their super, which is all permissible and legal. There's no dodgy stuff going on there. But that right there, I think that's a gem because you can do that as soon as the cash flow allows you to. So if you can generate the cash flow through whatever means necessary you can now and claim 5 back years of super contributions, like you said, in the next 10 years, I always think in terms of time relativeness and our kids and, my daughter's 12 going on to 13. 13 years has flown. Yeah. So if I'm able to do that now for the next 13, she's going to be 26.
Yep.
I'm going to be moving into that retirement phase. And now all of a sudden I've got super contributions that I've gone in over the next 13 to 15 years that I know I don't have to worry about selling the house, giving something to the kids to them to thrive off or invest in or live off. So, I think people don't appreciate the long-term game comes quickly because you're talking 5-10 year plans, if not more. And compounding interest in 10 years works wonders.
Well, think about the super. So again, just to harbour this point on superannuation and the contributions into a self-managed or a normal super fund. Like if, let's say your tax rate's like average tax rate's 35%. If you put it into super, they pay 15% on the way into super. You've got an immediate an immediate 20% return on your money, no risk. So no risk. So before the money's invested, you've made 20% on your money. Now, it's restricted. You can't touch it. So you can't touch it unless you're dead, disabled, or you reach preservation age. But as long as you've got the other pieces of your puzzle sorted, what an amazing return on your funds. And then just think about that then compounded over time. So there's 20% that you've got as a risk-free return invested. And let's say we've got another 12 years to go into retirement. That money had gone. That had gone to the tax man. That has disappeared. You're never going to get it back again. Now that money's invested, assuming it's invested well, that's going to compound over time. We do the numbers for clients all the time. It's staggering. Like, it's absolutely staggering and it doesn't need to be a huge amount, but if you make small incremental contributions to pay less to the tax man, keep more of it yourself, compound it over time. A bunch of clients that I have at the moment, we're talking about self-managed super funds, where they have a great desire for property, right? And you're hard pressed not to see super as a pretty good vehicle to actually own property.
Yeah.
Why? Well, if you own a property individually in your own name, you're going to pay tax on the income and tax on the capital gains at your marginal tax rate. Super pays tax at 15% on income, 10% on capital gains. When you get to 60 and you're retired, that same property, if you owned it inside your super, subject to some caps, pays zero tax on income and zero tax on capital gains. So we've got a couple of clients now where they love property. The purpose of the fund, if you ask them, they say, well, it's for long term, it's for retirement. I go, okay, well, so you don't need it for income. You don't need it for lifestyle. So super's an option. So they might not have enough in super at the moment. So we will aggressively do catch-up contributions to build their portfolios, get to the point where they've got sufficient to actually fund property, maybe with a limited recourse borrowing arrangement. Boom, they've got a property, hopefully purchased in a good area that's going to grow in capital value. If they sell that property beyond age 60 in what we call pension phase, capital gains tax, zero.
Yeah. Yeah.
It's pretty cool.
Yeah.
But people don't know this. You can chat GPT, you can Google it, but part of the challenge and part of the superpower of us as financial advisors is we're totally detached, and I can look at every single piece of the puzzle and see where they interconnect. Whereas, our clients are busy. They're busy with their life.
Yeah.
We'll connect the dots, and when they need, solicitors to do the conveyancing or establish the trust, I'm not going to do it.
Yeah.
I'm going to head them over to Paul, and he's going to set it up.
Yeah. I think if anyone takes anything away from this conversation is that voluntary contributions is nearly at minimum criteria. Like
cash flow permitting. So
cash flow permitting, yes. But I think, anything you can contribute to your super away from the ATO, and it's not tax avoidance because it's legally permissible.
Yep.
I think, sometimes people forget, you touched on it earlier, is that the ATO is coming after you every which way possible in terms of this spare bedroom tax or taxing you from working from home. They're actually finding ways to impose a tax on your principal place of residence, which has never been a thing previously. So I feel like there's all these test cases coming out to see whether these taxes will be valid. But you've got to think like the ATO. How can I implement or set my personal structures up at home? Do I register an ABN? Do I run a cleaning company? Do I run a home gym, for example? Things that, or, in terms of e-commerce businesses, like how do you set yourself up to claim as much money back from the ATO on what you've already prepaid through your PG? Like we literally pay a tax on a tax.
Yeah.
And everyone knows that. And you want to bring up tax at a barbecue, people roll their eyes because they're like, it's just the same thing over and over. Because that's what you hear from mass media. And I think a lot of people are getting more educated on, individually, how can we save ourselves money in terms of whether it be a travel car. And it's interesting, because the government's got strict criteria around whether you have a business car, whether it is classified as an actual business car or not. So, just what are the things you would say are the most crucial little strategies to implement at home to help with that cash flow?
Again, I always defer. I do the legal answer in a lot of these instances and say it depends, right? So everything depends, doesn't it? there's only so much from a cash flow point of view. There's diminishing returns in trying to, like if we're talking about improving cash flow, there's diminishing returns when you're trying to cut expenses. The most exciting way to improve cash flow is earn more money. And that sometimes is not that appealing to people unless they've got maybe an entrepreneurial mindset. And this is where like some of those examples you just talked about, like thinking creatively about how, like we're in a different era now where you can have one or two different side hustles on the side. And to your point, you can create some tax advantage. There's a reason why people enjoy self-employment, because self-employment, I actually just did a podcast with Bridie, one of our younger graduates, and it was about starting your own business. And what were we talking about? We're talking about just the fact that that like small business isn't for everyone. Like a lot of people have a like rosy idea of what small business is about, or having being your own boss, but there are definitely some tax advantages of having a side hustle. And again, but you need tax advice. So again, I'm not the accountant, so on the purely the tax advice front, this is where you got to have, like in your orbit, you've got to have a solicitor, you've got to have a financial planner and an accountant that can work in conjunction with one another. Yeah. What else can you do in terms of tax mitigation? So if we just talk on tax, we've talked super. From an investment point of view, I mentioned investment bonds. So one of the things that's seeing quite a resurgence now is investing on behalf of your kids in investment bonds, with a view that it's kind of a proxy for it's a combination of there's family trust, which offers some ability to sort of distribute tax between family members. You've got superannuation, which you get concessions on the way in, and then in the middle you've got these investment bonds. Investment bonds, essentially what it is, if you hold the bond for more than 10 years, your capital gains tax exempt with some conditions. Yeah. That's another way, particularly if you're going to be investing over a period of time. I think investment bonds are definitely in the mix. What else have we got? So just the use of superannuation, just for sort of because of the super is just a tax structure. And then probably at the tail end, it's probably a bit of a segue from the question, but on what's coming up a lot at the moment when we talk about legacy and tax and barbecues is the question of death tax. Right, this like
the hot topic.
Yeah, like people go, I didn't know there's a death tax in Australia. Well, superannuation.
So sorry to be the bearer of bad news.
Sorry to be the bearer of bad news. Taxman's going to get you somewhere.
Yeah,
and this is where you have to be a little bit careful. So I said before that there's great concessions on getting money into super, so you give it a concessional tax rate on the way in. The taxman's pretty clever, he tries to be, and if you don't do anything about it, he'll tax you on the way out from an estate planning point of view. So the way the rule works is that all the money you put in as super guarantee and salary sacrifice over the course of your life, that forms what they call the taxable component of your super. When a taxable component of your super gets paid to a non-dependent beneficiary, so an adult child or someone other than your spouse, it cops 15% plus Medicare levy on the way out. So you get $1 million that you've accumulated, and it goes to your adult children who are, independent, doing their own things. There's $170,000 of tax gone, but there's things you can do about it. So we're doing a lot of planning at the moment and again, this is to the legacy point. This is like around estate planning, legacy. How do we make sure that those people in that sort of wheelhouse between 65 and 75, what we can wash away that taxable component. There's a number of strategies. We call it cashing out and recontributing funds into super. What does that do? It deletes the taxable component, and so it means the legacy that you've set up for your kids and the next generation doesn't have a big chunk bitten out by the taxman. So at the tail end, tax management, that's a big part.
It's funny you say that because they're still talking about this death tax, and I always find, having worked in politics in legal policy roles, whenever the government floats an idea and then doesn't say anything, it means you'll hear about it over and over again in the next subsequent years, because they'll slowly introduce something that they've always wanted to introduce, which is, the UK has a death tax, and we normally follow USA and UK policies. So, it baffles me how many people don't know this, because under the same obligations, we must tell our clients about tax implications. So one of those mechanisms is through the binding nomination. And we're obligated to give our clients that advice because superannuation is treated outside of the estate. Every time I give that client that piece of advice, that we don't have a death tax, but if your binding nominations are going to your adult kids, that is a death tax because they will get taxed at a rate that you need to go and discuss with your accountant or your financial planner. And that's an opportunity to open up that discussion about, okay, who your financial planner is. Do you have someone advising you on how to best set up your investment structures? But the surprise on their face when I tell them, and I say, we don't have a death tax because I don't call it that, but essentially is once that death benefit payment comes out, and we're finding people who are trying to literally cash in as they're terminally ill on their death benefit payment. So they're not taxed. And I think that's one of the greatest areas that beneficiaries are now attacking, because you can make a claim, and if you contest it, you're literally going to a tribunal. So you're not actually going to a court. So the rules of evidence and procedure are a bit more laxed, and you don't have to waste money on legal costs because you don't have to have a lawyer to make submissions about family circumstances that you intimately know about. So it's a burgeoning area of precedents that are getting set without this overlay of the rule of law. There is procedural fairness and natural justice because that's what superannuation trustees provide. But ultimately, I haven't seen any decisions get challenged at a court proceeding to actually see the decision-making process of the trustee when they're making those death benefit payments to the surviving spouse, the estranged child.
Well, it should be maybe made patently clear to people that, again, you said it, like super is not an estate asset. So your beneficiary nomination is critical. And if you don't have a valid binding nomination of beneficiary, the trustee is the responsible entity in terms of making the decision about what happens to your funds. So people think I've nominated my kids to be the beneficiaries of and that might have suited when the kids were young, but you haven't changed it.
That's right, yeah.
And the discretion is left with the trustee. If your super fund might be Australian Super, it might be, whoever the trustee of your super fund is got the ultimate discretion on where those funds are paid. So you can tighten the screws around those things. It's generally, again, like most things, superannuation is something that people haven't really worried about. But now, like I said, we've got $3.5 trillion in superannuation and about the equivalent in property that's going to migrate from baby boomers down a generation. This is the hottest of hot topics when it comes to legacy and estate planning, and it's the stuff that people have to get right.
Yeah, and the ATO will trace the beneficiaries and see who received that payment. I mean, one of the mechanisms we use to protect the death benefit payment is the superannuation proceeds trust.
Yes.
So we have a testamentary trust that you can put into a will where the super gets paid into the trust, so the ATO can't penalise anyone with a death tax, and they're still talking about introducing a death tax, so we will see some form of it occur. Recently in the probate jurisdiction, they just uplifted filing fees with the probate registrar and the court and the Supreme Court. So we saw fees go from maybe max $1,300 to $2,000, $3,000. Now, if you have a really expensive high-end estate, you've got a $15,000 lodgement fee.
Yeah, wow.
And so could you imagine telling beneficiaries who aren't well off and everything's in properties, how the hell are they going to afford a $15,000 lodgement fee with the Supreme Court? So really the work gets distilled in the bigger firms. But that one piece of knowledge for consumers, I think, is highly vital, because a lot of them are walking through life thinking the superannuation is theirs, and to have to explain to them, and the realization as they're thinking, to tell them, no, you are a beneficiary under a trust deed that is the Aware Super or the CBUS Super Trust Fund. You do not own your super. That's why it's regulated by the government. It is held on your behalf, so you're a mere beneficiary. There's no expectancy that you're going to receive it, because it's conditional on certain factors, terminally ill and hardship and the like. So, yeah, it's extremely important. I tell people, if you don't have your wills, just please get your binding nominations done, because it's one of the biggest pieces of estates that's going around. A person might not own a home, but they'll have super.
And people will also, from an insurance point of view, insurance, most people will hold their insurance inside their super. So the other thing to add to what I said before about the death tax is that death benefit paid from insurance proceeds in super pays 30% tax plus medical level. So 32. So if you've got some life insurance in your super that was intended for your spouse, maybe you don't have that spouse anymore, maybe it was intended for the kids, but the kids are adult, non-dependent now.
Yeah.
There's a third of that gone. So if you had $1 million worth of life insurance cover, there's $320,000 worth of it gone. So this is the decision around like the interaction between your insurance, your estate planning, and your superannuation. Like you can make decisions about pulling your insurance out and paying it personally. To avoid that. There's so much nuance in that jigsaw puzzle for people's financial and legal situation that it's very hard. There's only the minority of people that can actually manage that themselves. Again, I think that's why I'm still in business after 25 years.
Well, you're talking to baby boomers who were paying 13, 17% interest rates on home loans and built their wealth over the course of their lifetime.
Yep.
They don't want to pay. They don't want to let that money go. They want that. That's legacy money for their children.
Oh yeah, and they want some age pension as well.
Or that, that's always an interesting conversation. I think we might leave that for another podcast. Well, Jay, it's been a pleasure.
Thanks, mate,
to have another chat, and I look forward to working closely with you on future matters.
Thanks, mate. Look forward to the next podcast.
Yeah, definitely.
Cheers. Thanks, mate.
Pleasure.